Marin Katusa's new book, The Colder War, is now on bookshelves. Marin pulls away the curtain on how Russia, China, and Iran have come to dominate the global energy stage and put the petrodollar to rest once and for all. Find out why Dr. Ron Paul and critics alike are calling The Colder War one of the most important books you will read this year. Visit PalisadeRadio.com and enter our weekly drawing to win a free signed copy of Marin's book. That's PalisadeRadio.com.
This is Colin Cattell with Palisade Radio. Before starting this week's interview, I want to announce our third book giveaway of Marin Katusa's New York Times best-selling book, The Colder War. Remember to visit PalisadeRadio.com and enter your name and email for a chance to win. This week's book will be going to Adele from Mississauga. Thanks, Adele, and everyone else who's signed up so far. Now today we have a new guest joining us on the show to discuss the gold market at large, and specifically the Peruvian toll milling industry. Peter Spina is the founder of both goldseek.com and silverseek.com. Peter, welcome to the show.
Hi, Colin. Pleasure to be on.
Peter, I think the last time we met in person was about 3 years ago at the San Francisco Gold Show. At the time, the industry was beginning to unravel, but few people expected it to fall so hard and for so long. I'd like to get your general thoughts on the precious metals market right now.
Yes, it's a difficult short-term call, in my opinion. We're looking at a pretty key technical point right now in the gold market, just around 1240 an ounce. So from a technical perspective, if we break this level, I think we could see some real fireworks in the short term. But then there's a lot of things to be concerned. The US dollar is very strong. The oil price has dropped dramatically, almost in half in the recent months. And you have the Western Wall Street investors still selling slowly now their gold ETF holdings and positions. So there may be some another final washout to deal with, and it's a tough call in the short term. In that regard, and gold could still hit our target. Kind of was around 1050, 1,000. Should the supports fall still, but I wouldn't be aggressively shorting gold at the same time, even though there is some still risk on the downside. I think the biggest risk is to the upside, and especially looking a year or 2, 3 out. So I'm still very bullish on the gold price, but the short term is still, you got to be cautious.
Yeah, and just for our listeners that don't know, you've been in the business for about 25 years, and you actually were kind of a pioneer in the gold sector online, creating the first real website for gold, which was goldseek.com. A couple years after you started that, the 1997 to 2001 bear market in gold stocks began. How does today compare to what you saw back then?
Well, it's interesting because there's similarities, such as back then you saw incredible deals and just real opportunities in the gold miners, which we haven't seen in the sector since then. But at the same time, you have the gold price almost $1,000 higher. So it just doesn't make sense in some ways. I think the miners are extremely undervalued, and it could still go down from these levels. But if you take a longer term perspective, I think it's an excellent time to be accumulating, especially in these pullbacks. Just like back at the bottom of the gold market, when you have this almost extreme pessimism where everyone's saying gold is over, there's no reason to hold it and own it. You have very similar kind of mentality, especially from the Wall Street crowd, saying the same thing. And you would think in today's age, after having gone through the 2008, 2009 financial crisis, that they would have learned a lesson. But the reasons for owning gold, in my view, has only increased since the bottom of that gold market 10, 15 years ago. So it's to me, it's actually an easier case to make now to be a gold investor into the mining stocks, even though we have gone through this difficult period. But compared to the bottom of the gold market back then, it does have a lot of similarities.
And before we hit record today on the interview, you were telling me that you're using this downturn as an opportunity to rebalance your portfolio and look for innovative companies, new strategies, so that even if the gold price does drop by another $100 or $200, these companies will still be making a profit and maybe will continue to move up while the rest of the companies continue to fall. And that brought us to the toll milling industries, particular in Peru. One company that people might be familiar with is Dynacor. Could you talk a bit about Dynacor, their business model, what they do?
Right. It's a really great business model. I like this concept of toll milling or gold ore processing, where they have these local artisanal kind of small scale miners in Peru there that are extracting some very high grade ore. A lot of cases around an ounce a ton rock, which is extremely high grade. And then Dynacor provides the milling side of the business, and their margins are very high. So it's a business model where the company's making money. They're providing a good service for these for these local miners, and they get a better price. There's a positive environmental impact, and the model works very well even in a declining gold price environment. So they're making good money even if gold were to drop, say, to $1,000 an ounce. It's also there's other things that are happening in Peru with the way that they're trying to legitimize there's so much gold being extracted by these miners. I don't know the exact number. I've heard upwards of 100,000 people are out there digging for this gold ore, but most of them are doing it illegally. So in this last year, the government's put forth this new system, and companies like Dynacor are there to benefit from that.
So Dynacor went ahead and got one processing facility up and running, and since then they've started to allocate some of their profits towards exploration dollars on an exploration project, which may pay dividends. But you've actually identified toll milling ore processing company in Peru that's kind of at the earlier stages, ready to take off, and that's Inca1 Gold. Can you talk about Inca1 a little bit?
Yeah, the Dynacor model works well, but the thing that like you just mentioned, is kind of unfortunate, is that they take their cash flow and then flip it into exploration, which is fine if you want to take that risk. But you look at the amount of money they could be making and reinvesting and building that model up. I would rather see them do that. So Inca1, they've come around this last year, and they've transformed from an exploration into a gold or processing companies. So it's been proven by Dynacor. They're just putting all the pieces now together, and they'll be soon producing at 100 tons a day there. And this is, again, high grade gold ore, and lots of opportunities to really grow the model. So I think their biggest problem is how do you keep up with all the opportunities for growth, and they're not flipping the cash flow into exploration, kind of burning the money. I like their approach a lot better, that they're going to be growing their toll milling gold ore processing business.
And just as a disclaimer to add, Peter, you own shares of Inca1, and as well as myself, this is a story I've been aware of for over a year now, and it's really come along. There's now some other entrants into the space that aren't necessarily ore processing yet, but they're trying to get in. What are some of the difficulties that management of Inca1's been able to overcome that might cause problems for newer groups? And this is more so to talk about how great of a job the management at Inca1's been doing.
Yeah, they've done an excellent job putting this together. It's there are barriers to entry to get the permits, and to source illegals, to have legal sources of ore, to get the plant up and running, and all those things that are needed to make this a successful operation. So they've got a big jump start, and they're putting together a very nice team down there. You see that and reflected in the share price. As I said, I'm an investor. It's one of my top holdings. And last year in this sector, that's seen a lot of the gold stocks get hit again. They're up almost 2-3 times in value over the last year, and they're still, I think, looking at 100 ton a day operation, quite undervalued. I think they've got there will be some imitators that will try to replicate this, but I think they're a lot more ahead. They've got a cushion of time there that they're already gone through this process, and building out the plant and so on. So
Let's step back a bit, and I want to talk more about what you're seeing technically. Silver is now looking pretty strong. We're recording this on Friday, December 12th, and the GDXJ has really been falling this week. Gold's held up pretty well, and silver's really looking good. What are you seeing, the metals versus the miners?
Yeah, that's also a comparison to the bottom of the gold market. If you take the ratio of GDX or XAU or HUI, and GDXJ wasn't around that long, but if you look at the ratio of the metal to the share price, it's at lows not seen since the bottom. So there's a real big divergence, but there's also the confidence in the gold investor is really weak right now. So you get a rally and then people get scared off. So what we saw in the summertime, I think, is a good reflection of that. So the second you have confidence from the gold investor that the price is not going to continue to fall or plunge down to 1,000 or wherever it may want to go, if investors see that the gold price is going to hold up around 1,100, 1,200, or 1,300, I think these mining companies are really going to take off. We might be getting pretty close to that. We may be in the bottoming part of that. It's really hard to call short term. But the miners versus the gold price, there's a big disconnect. And the second there's some confidence in where the metal prices are going to be at, I think that'll really accelerate and get some rallies going. Silver, that has really fallen a lot more than gold has, and compare it to copper or other commodities, that ratio, silver's way oversold. And you see the primary silver producers, a lot of them need $18, $19, $20 an ounce just to break even. So if you're an investor in those stocks, there's some that are still making money at these levels, and there's some that are losing money. So, as an investor, you got to see which of these companies have good balance sheets, or if they have enough cash to weather the storm and wait for the silver price to reverse. I could still, if gold were to go down to $1,000, silver could get hit again. It could go down to $12. I don't know. It seems absurd, but you have that risk. But from a risk reward perspective, okay, you've got $2, $3, $4 on the downside, and I think your upside is a lot more than that. So for me, from a mid to long term perspective, I like to be accumulating silver at these levels, and it's kind of in that way, it's a gift for the mining companies. They're having more difficulties, but if you have the right ones, it's a great time to be, rebalancing your portfolio, maybe taking some tax losses and getting rid of the companies that just are too risky at this point.
And Peter, one last point I want to touch on before we get off the call here is you got a bit excited that we're doing a book giveaway for Marin's new book, The Colder War. In fact, Vanessa, your girlfriend, will be interviewing him next week, and there's been a lot of great reception for the book. Can you talk about Russia? They've recently been purchasing a lot of gold. I know the oil prices hit them pretty hard. What do you see their influence in the commodity space over the coming years?
Yeah, there's a big thing going on here with Russia, and I don't think a lot of the Western investors appreciate what is happening. I think the situation in Ukraine was quite telling, although the Western media was quite biased and not really digging into it. I think there's a play for Russia here. I think Russia is trying to be marginalized. It's been part of the plan for some time, trying to bring Ukraine into NATO and kind of surrounding Russia. It's just another step forward to get them to capitulate and open, to have them maybe bring in another regime that's more friendly to the West. They're very powerful with their energy resources, between, I think, their natural gas reserves with the Ukraine or Crimea area. They're looking about a quarter of the global's natural gas supply, and then you look at their commodities and energy, and it is an amazingly rich country. But from kind of the bigger picture, what really gives China and the BRICS strength is Russia. So I think if the West was able to squeeze Russia and get them out of the picture, all of a sudden you marginalize also China, and the U.S. The U.S. empire will continue to be dominant for many more years. So I think the real target here in the Ukraine situation isn't Ukraine. It is a prize in itself with the fertile farmland and the energy resources in Ukraine, but really it's all about Russia. So Russia is playing, is pushing back, and they're finding, there's other tools in the West's toolbox here. And I really believe that the oil price is falling not just because of weaker demand and oversupply, but I think a part of it's also to put a squeeze on Russia. So it's going to be interesting to see how this plays out. They've been, like you said, buying a lot of gold recently. We'll see what happens. They've got about $500 billion in their foreign reserves, and they could probably survive a low oil price for some years. I think actually the situation is giving a lot of power to Putin from the Russian people. They see that they're being attacked, and they're kind of rallying behind him at the moment. So it'll be interesting to see how this plays out, because it's in today's world, it's you have these proxy war fronts, but you really also fight wars through the financial sector. It's a financial war, and we'll be interesting to see how Russia pushes back. The U.S.'s dominance in the world, the value of the U.S. dollar is really the key. So we'll see how they try to subvert that power, if they really can do much. But it's something that I think most Western investors don't realize the risk, which is underway with this push against Russia.
Wow, that's some great analysis. We might have to get you back on the show to just talk about Russia in the future. On that note, Peter, thank you for your time, and we'll get you back here soon.
Look forward to it. Thank you, Colin.
Vladimir Putin is a self-made man. He did not come from money. He did not come from a royal family. He was your blue-collar boy who did well. Putin has positioned himself in the center of the chessboard, in the energy matrix of the world. Right now, Putin and his allies in China, India, Brazil, all of the emerging markets are aligning together to fight the European Union, the IMF, and America. Eventually, the rest of the world will realize that Obama and America are hiding behind this curtain with no powers anymore. Putin specifically has positioned Russia to become a global superpower, and America has never been more vulnerable than it is today.